Trading should be more like watching paint dry. If you want excitement, go to Vegas, at least you get free drinks. It should not be gambling. Trading should be extremely, extremely boring. So if you're trading without a stop loss, you are gambling. Do you want to be right or do you want to be rich?
That's the interesting game here. I always tell my students, it's a battle with your own brain. You're not actually battling the markets.
You're trading against yourself. There's no question. The notion of bears and bulls is kind of a misnomer. There's no guy on the other side who's trying to crush you. You're trying to crush yourself or avoid doing so. And at the end of the day, there's always a trade there. There's always profit to be made regardless of what the other side is doing. It's just a matter of whether you can actually follow your plan once you've started instead of making an emotional decision and taking a poor exit.
Bitcoin it's a near bulletproof network. He said this thing has tried to been hacked by terrorists, CIA, governments, everything. He said, Brian, this network has never gone down.
So the network is secure. It's never gone down. Think about this. Bitcoin price dropped 55 or 56% in a matter of weeks. We didn't need anybody to come in and instill cash into it to keep it going. We didn't need to be bailed out. It's the only free market left in the world. So even taking away the security of the network, the fact that you can have 55% volatility to the downside and you can have 50% of the miners going offline at the same time and everything just continues to run smoothly without any centralized authority having an impact, that should tell you everything you need to know about Bitcoin. The power of your dollar is dropping. That's a fact. You need things that protect you against that. Here's your options.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go? This is London Real. I am Brian Rose. My guest today is This is London Real. I am Brian Rose. My guest today is Scott Melker, the former music producer turned cryptocurrency investor, trader, and advisor. As a DJ, you work with some of the biggest names in the music industry like Kanye West, Snoop Dogg, and Justin Timberlake before turning your attention to the world of crypto, trading, and investment. You are the host of the Wolf of Wall Street's podcast, where you speak with key figures in the world of crypto, and your writing has been featured in the New York Times, Wall Street Journal, and Forbes. You were named Influencer of the Year by Binance in 2020, and your mission is to educate as many people as possible on the benefits of cryptocurrency while ensuring new traders don't make the same mistakes you did. Scott, welcome to London Real.
Thank you so much for having me. It's an honor.
Scott, it's great to have you here. I can't wait to get into a bunch of your ideas on traders, especially new traders. It's really, really important stuff. Strangely enough, 7 days ago in this studio, I had a new crypto trader. It was my 17-year-old daughter, Gabby. And, we spoke for an hour and 20 minutes about crypto, DeFi, monetary policy, you name it. But the thing is, she had actually never owned crypto before. So afterwards, we went to my office, got her a MetaMask wallet. I sent her some ETH, and now she's in the process of sending grandma some ETH in San Diego, California. Before this, grandma, my mom, has only invested in actual physical property. She runs about 50 rental units, and that's how she survives in San Diego. So we're bridging the gap here. And I'm a big fan of taking action to learn. I've got the DeFi Academy, where that's what I have my students do. I have them take action on small sizes so they can get that feeling of being in the game. And I was curious, what would your advice be to my daughter and my mom, who's 76, for their first 6 months of, I don't know if we want to call it trading, but they're going to own cryptos, right? They're probably going to have the tendency to buy some other cryptos. What advice would you give to them for that first 6 month period?
I'm obviously not a financial advisor technically, but the way that I would approach it, that I talk to people about approaching it all the time, is sort of as you said, right? You want to have skin in the game, even if it's minimal. Buy a little bit, hold it, learn how to transfer it, learn how to custody it, learn how to secure it. Do all those basic things before you even start worrying about it growing or worrying about trading or swapping for other coins and things like that. I mean, people have been investing and accruing wealth basically the same way throughout time since as long as there's been markets, and that's to buy, hold, and be patient, right? So I don't really recommend that anybody initially start to trade. I recommend that you buy some and then you go down that rabbit hole. You start to learn, understand why it's important. That's not the path that I took, frankly. I came in as a trader. I was trading other markets. I heard about this market of mythical unicorn 100x pumps in a day. This is in late 2016, 2017. I came for the dollars. And only once I was really digging in and trading it did I understand that this was such an important asset class. It was really changing the world and was a hedge against a lot of things that I didn't really understand were so problematic until I got into crypto. But my advice to them, as exactly as you said, get a little skin in the game, learn how to secure it, study it, dollar cost average, slowly buy more. Don't be concerned with the price at all. View it as a multiple decade investment, not as a multiple day investment, and move on from there.
Really good advice. And I want to kind of, at some point here, get back into some of your history of trading, because I think a lot of your IP comes from making mistakes that gave you those lessons to move forward. I know I made quite a few back in my day. Bitcoin is up, and I was worried, Scott, about saying that because it might date this video, but that means this will probably be relevant for the next 10 years. I could be saying Bitcoin is up because we know it's going to go up and down with high volatility, probably for a decade. You could argue the volatility might drop and other coins might take over that volatility, but we're in one of those kind of crazy upswings right now, which brings a very different kind of emotions than the downswings. I potentially think it's more dangerous as a new trader. I call it the I got married in Vegas syndrome, where you end up making poor decisions, when in the good times, the 20th shot of tequila, the tattoo that you can't even read, versus the I got so depressed I jumped off the bridge type scenarios. What do you observe about traders in these uptick times that you try to remind your followers on Twitter to maybe just think of differently than, say, the bear markets that we've seen in a few months ago and a few years ago?
I've DJ'd for 20 years. I have my share of bad Vegas decisions and bad trading decisions as well. So I can definitely speak to this. I think that you're absolutely right. But that what you're describing at the dead bottom and towards the top are two sides of the same coin, right? They're the extremes of human emotion. It's fear and greed, but effectively it makes you do the same things, right? Which is make irrational decisions based on your emotions. And that's what you want to avoid. So it's FOMO, as we call it in this market, obviously, fear of missing out. The higher the price goes, the more you want the asset. I'm sure not anecdotally that you've had many conversations where you told someone they should maybe think about buying Bitcoin at 10,000 and they weren't interested, and then called you and it was 60 and told you they were buying. Right. And that's that same emotional reaction to seeing something go up, believing that every time it goes up, that means it's going to go up this much further, and buying it. So what I would say to new traders, if you do insist on trading, is control your emotions. It's almost impossible, by the way. That's the skill that I would say 95% of traders lack. And that's why they say 95% of traders, based on studies, generally cannot even beat simply buying a market index and sitting on your hands. But it's that control of the emotions on both sides. I don't know if it's more or less dangerous. It's certainly more dangerous if you're a buyer, but there's nothing worse than selling the dead bottom right before a bear market ends and goes up, right? I know a lot of people who sold Bitcoin at 30,000 within a month, and now we're looking at $47,000, $48,000 Bitcoin as we're recording this. So I would say that it's about controlling emotions. And when price is rocketing up, you switch your mentality to maybe I'll miss it, and that's okay. As a trader, you're still dollar cost averaging as an investor, but as a trader, maybe I'll miss it, but these are the areas of support if you're using charts where I would be interested. So buying the dip, basically, you change your mentality to buying the dip and selling the rip, as opposed to the opposite. So you look for those opportunities when price comes down a bit, but you still believe that the bull run is intact, and that's where you place your bids.
Yeah, I mean, you hit it on the head there. Trading is all about controlling your emotions, but it's easier said than done. Much easier said than done. And that fear of missing out is just that natural human instinct. I remember my first job was on Wall Street in 1993. I got hired there right out of engineering degree. And they gave me phones to the Board of Trade and the Mercantile Exchange, and I was trading government bonds and interest rate swaps, but no one taught me the mentality of trading. And I soon realized that they told me to buy low and sell high. We were trading derivatives, so we could sell high and buy low. But the natural human instinct, strangely enough, is to buy high and sell low, right? Fear of missing out. And then, selling on those lows when it's actually the time to take a breath and just look at those long-term averages, right? Go listen to, Raoul Paul for a bit, or take a step back and just think about the long-term aspect of that. And yet that's not what we do. It's very difficult to kind of control those emotions, but that's what we see. And one final thing you said there, which is interesting, the person that doesn't listen to you at 10,000 calls you at 60,000. I remember in 1999, I was in New York City in the dot-com boom. I was a CFO of a startup, and the taxi drivers, I don't know if you remember, were trading internet stocks. And I was like, what are you talking about? It was crazy. But if you remember when Bitcoin was hitting its highs last time, Aunt Margaret was all of a sudden trading Bitcoin. And that's when sometimes it's maybe overbought. Is that a sign that you look out for or not?
Yeah. I talk about this all the time. Mainstream is the greatest counter indicator, right? And when your family members and your cab driver and the guy who's cutting your hair start asking you about coins and mispronouncing them, at the very top, my barber actually asked me if I owned any Ethereum, right? And obviously meaning Ethereum. And I said, well, that could be a good signal that we're at the top. But I was screaming about this as a perfect example a few months ago when Elon Musk went on Saturday Night Live and everybody was asking me if they should buy Doge because he was going to pump Doge on Saturday Night Live. And I said, this is going to arguably be, I can't predict the future, but my prediction, I think this will be the greatest buy the rumor, sell the news event in the history. And that was the dead top, obviously, of Dogecoin, which is probably the best example I have ever seen of retail FOMO and the opportunity to get out right at the top at a very obvious moment. But it's interesting, something that you said is that, they teach you to buy low and sell high. And I've always made the argument that that statement should be revised to buy, sell higher, right? Because giving the expectation of buying low and selling high gives people the mental the belief that they should be looking for the bottom and the top. And if you're a trader, actually the momentum is in the middle, and that's where the meat is for your trades. So you don't try to buy the bottom. You look for the bottom to come in and then a confirmation of the bottom, which may be 10, 20% higher. When it flips, a key level back to support, and then you buy, and you don't try to find the dead top. You exit somewhere reasonably ahead where you make money. So listen, if you're buying Amazon stock, if you're investing in a market and you have a really long-term trade and you know that it's likely to trend up, buy and sell higher. You don't have to buy the bottom. And the idea of buy low, sell high makes everyone feel like they've missed out. If you tell someone to buy Bitcoin low and sell higher, they're never going to buy, because low to them may have been 1,000 or 10,000 or 20,000 or 30,000.
Yeah, no, it's a great point. But trying to tell that to people is hard because they always see money on the table on the candlestick chart, right? And I know seasoned traders, buddies of mine in New York City, that, they still will be upset that they missed that 20%. And they've been doing this for 20 years. They should know better. And they do know better. But still, there's always that thing in your mind thinking, I could have, I should have. This is the human brain in action. And the truth is, trading discipline, it takes years. You could argue decades. I remember sitting next to some salty, old, proprietary traders on the trading floor at Bankers Trust, and you look in their eyes and they got the lines on their face, They've just been there, done that. They've seen the emerging market crashes. They've seen the Asian crashes. They saw the Latin American crashes. They've seen it all, and they're a little bit more measured, but even they can get a little emotional sometimes. And that's the interesting game here. I always tell my students, it's a battle with your own brain. You're not actually battling the markets, right?
You're trading against yourself. There's no question. It doesn't, the notion of bears and bulls is kind of a misnomer, right? There's no guy on the other side who's trying to crush you. You're trying to crush yourself or avoid doing so. And at the end of the day, there's always a trade there. There's always profit to be made, regardless of what the other side is doing. It's just a matter of whether you can actually follow your plan once you've started, instead of making an emotional decision and taking a poor exit. And that usually comes in the form of, well, hopefully you're using a stop loss, first of all. But if you're not using a stop loss, you shouldn't be trading. But let's say that you are using a stop loss. You have a plan, you have a target, you have an idea where you want to take profit, a strategy for doing so. That's all good and well when you enter the trade, but we know that once it gets going, people tend to change their plan, and that's the biggest mistake people make. Your moment of clarity is when you plan it and you set your bid before it actually fills, right? That's when you're making your best decision based on what you think will happen. Once price starts dropping, it's purely emotional. There's no more rational analysis you're doing to better your trade. All you're doing is trying to convince yourself to move your stop loss down. I'm going to just move it down a little bit. Price is going to bounce right there. I know it's going to bounce right at my stop loss. You move it down, you do it again, you end up getting liquidated or stopping out, 30, 40% lower than you would have and blowing up your account because you intended to take a 1% portfolio risk and you lose 5 or 6, right? And it happens over and over again. And on the flip side, I plan to take profit. This trade I entered at 90 cents. I'm going to take profit at $1. Oh, it's at $1. It's going to $1.50, man. Gets to 120. Oh, it's still going to 150. You stop out at 70 cents when it drops. It's just how it works.
I love that you just explained that, because I try to explain that same thing to my students, and I think you just did an eloquent job there. It's funny because when I meet a bunch of people that have been, in the crypto markets for 6 months or even 6 years, a lot of them don't have that. I call it almost like an algorithm in your brain. You're almost programming your behavior before it happens. You're almost like the Terminator. And they're used to, checking prices on mobile phones, trading at 2 a.m, trading when they're happy, they're sad, they're drunk, they're mad, and trading with more frequency than they should be. And then I come in and I say, guess what? We're going to trade maybe once a week, maybe once a month. Before the trade goes on, you put a stop loss in and you know where you're taking profits. And they're like, you're taking all the fun out of this. And I'm like, this shouldn't be Netflix. This is trading and this is P&L. You just mentioned stop loss. Let's talk about this, Scott, because I felt like I put a big wet towel on my students when I talk about stop loss. And it's funny to see the brain argue against stop loss, right? Like when you tell your kids they got to go to bed early, they come up with all sorts of really good reasons why they shouldn't. With the stop loss, they say, well, what if I'm hodling? The markets are volatile. I get triggered. There's traders out there trying to trigger my stop. I'm sure you heard that one, Scott, right?
Oh, yeah.
So talk about, first of all, what a stop loss is. And also, where's that program profit trading in there? And maybe we can give an example. Like if someone went into Bitcoin right now at say 48,000, what would be a really sensible, smart, long-term strategy for putting those pieces in? And maybe explain to people why their emotions are going to change right after that trade.
Sure. There's a lot to unpack there. So looking at Bitcoin, as an investor, I'll buy it at every price. And I do. I dollar cost average blindly. As a trader, this is not somewhere that I'm interested in buying. In fact, if I was a shorter term trader, I might be looking to sell a bit, right? If I was just scalping purely with no emotional attachment to the asset and no longer term position. To me, a key level on the Bitcoin chart was 42,000. That was the top of the entire move from the all-time high at 20. We stalled there for about a month. Tesla bought $1.5 billion worth of Bitcoin. Price skyrocketed for 42 through 42 and headed up to 65. When it lost that 42 level, to me, was sort of when the shorter term bear market narrative was entered. And we stayed there since May 19th until just a few weeks ago, right? So almost 3 months, an entire boring summer of people finally getting out of their houses and enjoying their lives and not trading. And it took quite a bit of time to consolidate, accumulate, and break that level. So levels are flexible. I'm not saying if price goes to $41,999 that your thesis is broken. But to me, if I was going to enter a trade, and why I wouldn't now, that's too wide of a stop for me, because I think everything still looks bullish above 40 to 42,000. So that would mean I'd have to put my stops in the 30, below 40,000 somewhere. And that's just way too big of a gap to make the risk reward worth it buying at 48 as a trader. So I personally, I'm always looking to enter more. I have bids in that area. I'm looking for the drop to buy. And if I miss it, life goes on, right? So my stop loss would be maybe 39,500, 39,700. So I'd much rather enter at 40 or 41 than enter at 48, right? Because my position size would have to be so small entering at 48 to be able to manage risk and only take a small portfolio loss. So that's one thing. The general importance of a stop loss is that, and what people don't realize, they view it themselves as losing. It's not losing. It's an invalidation of an idea. It's admitting you're wrong. That's the problem people have with it, of course, because people hate to be wrong, and that's what destroys traders. But it's an opportunity to find a better entry, in my mind. And if you say that mantra over and over again to yourself over years, you'll start to not view it as a loss, but an opportunity for a better entry. Okay, well, I stopped out here. That means it's going lower. I can get in lower, right? If my thesis is correct, let's look at the next area where I would buy and try again. And you can make up for that entire loss manyfold if you're right on the next entry. So to me, you're gambling if you do not have a stop loss. So what's the importance of a stop loss? You're looking at a chart. A chart is just a visual manifestation of human emotion, like we talked about before. Why do support and resistance and all these lines exist? They exist because this is where all the same people are going to make the bad decisions. So your goal by looking at a chart and as a trader is to make a good decision when everybody else is most likely to make a bad one, right? This is where everybody's going to panic sell. I'm going to buy it. It's going to go the other way, counter trading the crowd. But you're gambling if you don't have an invalidation, because then you're just emotionally hoping, and hope is obviously not a strategy. So the first way you should approach a trade, you look at the chart, figure out where would I ideally like to be in, right? What's a good entry? Or you can start at the stop loss. Where is any bullish idea invalidated? Figure that out. Figure out where your ideal entry is, calculate that gap, and then back calculate it to your portfolio size to figure out the size of your position, right? I want to lose 1% of my portfolio. This is how much I will lose on this trade if I'm wrong. This is how the size of that trade to make that math work. Seems complicated, seems boring, like you said, but it is. There was a famous quote that I can't place the trader that said it, but that trading should be more like watching paint dry. If you want excitement, go to Vegas. At least you get free drinks, right? It should not be gambling. Trading should be extremely, extremely boring, because you should have a plan and wait. And then once the plan's enacted, you shouldn't watch the chart to figure out what's going to happen, because you know where you're going to exit, either up or down. So if you're trading without a stop loss, you are gambling. 100% gambling. And like I said, this comes back to the core idea. Do you want to be right or do you want to be rich? Because your average trader, maybe if they have an edge, is right 55% of the time, right? Yeah, I was a part of a sports gambling group where we bet on every single NFL game for the entire season on a spread. And the person who gets the most right at the end of the season out of hundreds of people wins the entire pot, huge pot. And every year it's consistently someone who gets 56, 57% of them correct, right? Against a spread, because Vegas is good. So your edge doesn't come with being right. Your edge comes with being wrong small and being right big, right? So taking the right trades where you're going to lose very little if you're wrong, and where you have a ton of upside, so that 10 great trades in a year can invalidate 200 misses, right? And so once you program yourself to realize you weren't wrong, it doesn't matter if you're wrong. It was just you took a small loss and your next one will pay for it, or your 10th one will pay for it. It really starts to change the way you approach the market.
Yeah, that's powerful. I like that, entering at a better level. And it's when people get cleaned out, it's that one time they didn't stay disciplined and didn't have the stop, right?
Correct. You lose your entire stack on one trade because you get liquidated and moved your stop loss, or you revenge traded. That's the other one, right? Your stop loss does hit, and then you enter immediately again because you feel like you were wrong, which is the same thing as not using a stop loss.
Right.
Revenge trading was my biggest problem as a trader in the early days, because I hated being wrong. I got pissed off and I came right back in. And it turns out I was actually right to have my stop loss and take that loss, because that was a good plan that I had before I was emotional. And revenge trading over and over again, you just basically keep taking the same loss of the same trade. It's like banging your head against the wall.
How long would you wait between getting stopped out and getting back in? Like hours, day?
It could be momentary. I mean, it could be literally, within an hour, certainly days. I came up with a rule for myself, and people need rules. You need to know yourself and come up with rules. And I share this with people all the time. Very difficult for me now because I'm doing so much analysis for other people. But if any trade that closed, whether profitable or at a loss, I close that chart for 24 hours and don't look at it. Like a firm rule that I'm not allowed to even utter the name of that asset for 24 hours, right? Very, very hard with it's Bitcoin and you're looking at it all the time, but and so that also prevents you from jumping back in. The same thing that makes you revenge trade when you lose makes you jump back in higher when you exit a trade for profit and think it's going to continue going up. So you buy again and lose the entire amount that you had made.
That's a great rule. Maybe you should be longer than 24 hours. I guess it depends on what you do and your frequency.
Yeah, if you're a day trader and you're only trading 3 or 4 assets, I think 24 hours is sufficient.
That's a great rule, because when you look at that price, I mean, you can take example. If it's up 500, you're going to have this emotion. If it's down 500, you're going to have this emotion. And no matter how seasoned you are, you don't need those things chipping away at you. So leave it for 24 hours. That's a great tip. Let's talk about taking profits. So we go in at 48, we set our stop loss. I realize for you, you're not buying, but if this was a buy level for you, your stop loss would probably be, depending on how much portfolio you want to lose, a couple grand below, for example.
Sure.
Profit taking, how do you go into looking at it? Do you average out the profit taking, and again, it probably varies, but what's a basic way of thinking about it? Okay.
I personally believe in averaging in and averaging out of positions, right? Because I think that a lot less stress when you have less on the table. Even if it's the full amount that you plan to and you're totally comfortable with that, every time you sell a little bit, take a little bit of profit, you reduce some of the stress on that position. And like I said, we all talk about lines on charts, maybe 42 grand, but that's kind of 40 to 43, right? So it's sort of a zone. So what I'll do if I'm looking to enter is I'm bidding that entire area, 5 to 10 different bids spread out. Rarely do I fill the whole position because usually it doesn't get all the way down to the lowest ones, but if it does, awesome, right? So I do the same thing on the way out. It can be using Fibonacci retrace. It doesn't matter what your strategy is. Fibonacci retracement, drawn horizontal resistance levels that you like. That's what I usually do. It can be just mathematical. Every 10%, I'm taking 15% off the table. Every 10% rise, whatever it is. But every time you take a little profit on the way up, you kind of reduce the stress of your next decision. And I think that a lot of the mistakes that we talked about already earlier is because people view every position as binary. I got in all of it at this price. This is my target. I'm selling it all. Well, if you sell it all, that's when you FOMO back in because it goes higher. But if you still have 50% on the table or 30% of the position, you have the upside if there is more of a runner in that trade. For me, because crypto has such outsized gains, I used to trade stocks, and if I made 10, 20% in a year, I'd be super psyched. Now in crypto, people feel like if they didn't make 10% 20 minutes after they entered, that it's a loss. But so you have these 10, 20x, 100x moves, depending on how long you've been here and what you grab. I love to take the last 10, 20% of a position and move it into my investment portfolio and never look at it again, just in case it's an utter moonshot. And a couple of years later, I come back and that has turned into a significant player in my portfolio. So sometimes I never exit the entire position if I have some of the house's monies left that I can ride.
That's super helpful. I guess last question about kind of stop losses and profit taking. Do you believe that once a trade becomes profitable or reasonably profitable, you should always make sure that that's a profitable trade?
Lock it in.
So that means you'll adjust your stop loss up with it.
The only time I'll change my stop loss is into profit. Never down. Well, unless you're shorting, of course, but is to move your stop loss into profit at a certain level. And that can also somewhat be managed with profit taking, right? You take a little bit of profit now, even as you move, even if you kept your stop loss, you've reduced your risk and you're going to take a smaller loss if it drops. But generally, depends on the chart. If you've broken a key resistance level, flipped it to support, I'll now move my stop loss up as if I was taking the trade at that level, as opposed to the level below. So I'll give myself a few percent below that new support. And sometimes I'll have measured stop losses as well. I'll keep some of the stop loss where it was. I'll move up some of the stop loss. I'll take a little profit. It's a lot of management, and you should have that generally planned in advance. But yeah, there's a lot of ways to skin this cat, but there's nothing worse than turning a major potential win into a full loss. And that's what happens to a lot of people if you don't take profit and you see it rocket back down and fully stop out. So I don't necessarily think you should move it right to your entry, because you want to get some profits, maybe a little bit above your entry, lock in some profit, and then you're no stress.
All right, that's super helpful. I want to ask you about news, the media, how you consume news, or make sure you don't consume news, because that's important these days too. But before we do, you mentioned charts a lot, and it sounds like you look at them a lot. Well, you look at them somewhat, and maybe you can talk about how people should engage with charts, especially people new to the market who probably have never seen a chart before, and some of them get really complicated. First of all, does a trader need to look at charts at all? Second of all, can you go down the chart rabbit hole and never come back out? And third of all, what's the middle ground, and does that vary by person?
I think the middle ground is probably the most sensible, and that it varies by person, sort of as you touched on. So I have friends who are equity researchers at hedge funds. They're not necessarily executing trades or looking for levels, but who basically trade for a living and have never looked at a chart in their lives, right? They're analyzing the fundamentals of a company. They're listening to the quarterly earnings call. They're deciding whether this is a fundamentally strong position and buying accordingly, or selling if they believe that it's not. Never look at a chart. So there are plenty of people who are incredible fundamental analysts and trade that way. I think most people who are traders, especially if you're trading on any lower time frame, below the weekly, monthly, do look at a chart. And then once you dive into looking at charts, there are a million ways to do it. I can tell you that in my early years, I like to joke that if you looked at one of my charts, it looked like you were on acid at a Pink Floyd laser light show or something. There were so many lines and colors on this chart and indicators. And with time, the more you do it, the more you realize, as I said, you're just looking at human emotion and trying to make very simple decisions, and your charts become very, very clean, right? You have a couple lines, you make your decisions based on that. I think it's really important to note that most people who have gotten wealthy in markets since they've existed, not only have they never looked at a chart, they probably don't know that charts exist, right? The wealthiest investors in the world have found good assets. They've used money that they don't need to take out to buy them, and have waited most of their lifetime and gotten rich, right? And it's such an important distinction, because you get into trading and you think you need to know the exits and the entries, and you got to find that and learn how to chart. And none of that really matters if you're patient and you pick the right horse.
Yeah, there's that old expression, buy real estate when there's blood on the streets. And, that comes from 50, 100 years ago. And it's almost like a mentality the wealthy have known, right? Let's invest in real assets. Let's hold them. Let's pass them on in a tax-free manner, right? Let's do these things.
Take a loan.
Yeah.
Pay it
take
off
a
when
loan.
I'm dead.
Yeah.
Of course.
Leverage up, push taxes back, or, invest in instruments that aren't. And you're right, they probably haven't looked at a chart. I guess the one thing I like about new people investing in crypto assets is, first of all, they're owning assets. These also happen to be, deflationary or non-inflationary assets. And so it's probably one of the first times where that's actually happening. I've had Robert Kiyosaki on my show many, many times, and he's had his whole quadrant for a long time trying to explain people about owning assets, and poor people, work for money, rich people make money work for them. And for a lot of people, they never have enough money to own a piece of property, or real estate seems like something your mom or dad does. And so, like you say, just having that and owning it and holding it is probably something you'd never see a 20-something-year-old do ever in the past. So that could be a good experience. And I know a lot of people that don't look at charts, but you should also be able to look at one, I think, and get a rough idea, and then don't expect the chart to predict the future, because it won't. It's one of many components that goes into your head, right?
Agreed. Listen, and I'm saying all of this, and I'm a technical trader, right? I trade with the chart. I don't care about the news generally. If depending on the cycle, I obviously track the news because it's important to me, and I may visit that for a very long time frame thesis, but everything I'm trading in between is strictly on the chart.
Right. Okay, that's helpful. All right, let's talk about the news. Really important. You're on Twitter. You have a big following on Twitter, which is something. The Twitterverse is a crazy place as it is. I mean, that's not even the news. That's almost like every single synapse fired in every single person's brain, depending on who you follow and the hashtags you follow. I've looked at this market hard for about 6 months, and I always tell my students, news, in my opinion, usually has one of two agendas: to get you to get emotional, and sometimes to transact. Now, I'm not saying there's a big conspiracy out there, but I'm just saying those are the two things that we probably see. And now with the mobile apps and everything, it's unlike anything I ever saw back in my day. And both of those impulses are usually wrong when it comes to trading. How do you teach new people to even process news? I mean, you just talked about going blank on an asset for 24 hours. Is there a way that you can go on, I think what Tim Ferriss called a low media diet back in his 4-hour work week days, right? Where he wouldn't consume media. How do you tell people to do it?
Yeah, I don't think that the news cycle has much effect on cryptocurrency, certainly, and on Bitcoin. In fact, I think that the news follows the price as opposed to preceding it. And it's something that we see every single time Bitcoin drops. And this is not unique to Bitcoin. This happens with the stock market as well. The minute it goes down, you start to get all the bad news and all the reasons it's going to zero and all the reasons that this is the generational top that we've all been calling for the last 30 years. We're finally right. So let's take Bitcoin, for example. Bitcoin tops. Somebody sees an opportunity to rinse a whole lot of leverage out of the system. Forget the news. The reason Bitcoin dropped from 65,000 to 50,000 is because $10 billion were liquidated and 10,000 and a million individual traders had their accounts liquidated. That's an opportunity that someone with a lot of money is going to take every time. Okay. So let's just say that the first beginning of that move was purely technical. It was traders. Same reason we saw gold dump a couple of weeks ago, by the way, because it lost a support level, stop losses triggered, there was a cascade and it went down. That's gold. So it's much easier on an asset like Bitcoin. So we have a cascade of liquidations. Price drops to 50. Price precedes the news. Then the bad news starts. Tesla's not going to accept Bitcoin for cars anymore. There might have been 10 people on the planet that would have ever traded their deflationary asset, hard money Bitcoin for a car that's worth 30% less the minute you drive it off the lot. But let's take that aside, right? So nobody's buying a Tesla with Bitcoin. It was the idea that maybe they could. That sparks the energy debate, which we've had for 10 years and happens every single time Bitcoin drops. That leads into China. China banning Bitcoin has happened 17 times and there's still Bitcoin in China. That leads to India. That leads to Bitcoin's only for criminals and hackers and ransomware. And that's where we're at now. And that is the same negative news cycle that happens after Bitcoin price drops every time, which instills, as you said, fear in people and causes weak hands to exit their positions at the bottom. And if you look at on-chain metrics or anything fundamental about Bitcoin, while all of that was happening, the biggest wallets were buying the entire time in the 30,000 as retail continued to one more story. I'm going to hold my Bitcoin. I'm going to hold it. Oh, one more negative story, finally give in and sell, and then price eventually rockets. It's the same with every market. It's the same every time. And it also happens with the good news, by the way, right? Just like you said, the Uber driver, the barber, the Bitcoin's going to $10 million when it's only at 20,000. Those are the signs that you're starting to get the positive news cycle to the upside.
Now, Scott, tell me if I'm wrong, but does this happen 10 times more in crypto than it does in equities or any other, market we've seen probably in history? It's magnified in this space, right?
It seems like it, but I can tell you, and I'm not old in this market at all, right? I mean, given this market's only existed for 12 years, but I got in 2016. There are people I interview 14, 13, 11, 10, have really been here since the Bitcoin pizza days. Yeah. And back then it was the same general narrative, but it wasn't the media, right? It was the community. The media didn't talk about it. The media didn't talk about Bitcoin. So when I got in 2017, if Bitcoin was mentioned in Forbes, price went up 15%, right? Because there was no news cycle for Bitcoin. And this is the first time, I think 2017, when retail really started to pile in and you had that first sort of bubble, that was the first time it became part of the news cycle. But 2020, late 20, early 21 was the first time that you saw it as a part of the ticker on CNBC, right next to every asset, as a part of every single 30-minute financial news program. So I think it's also a function of just the assets maturing, mainstream adoption, or at least awareness is happening. And therefore they're talking about it more, which then amplifies every single story because people don't understand the assets. So one network runs a negative story, 10 more networks run to pick up that story and give their own opinion as news on that story. We know how the mainstream news cycle works, obviously. So I do think right now that crypto takes a beating on the downside because everyone's talking about it. It's kind of a good thing when you think about it in that regard.
Yeah, it's better than the old days when nobody would talk about it, back in 2013 and 14, when everyone, like you said, wanted people to talk about it. This definitely seems magnified, even things I've seen over the years, even like compared to .coms. Maybe it's because it's got this peer-to-peer network. Maybe it's new investors. Maybe it's a super mobile oriented. Maybe it's a digital thing. And also this news is digital and it's come of age in the age of Twitter and mobile Twitter and Instagram. I don't know. something feels magnified. It also seems to be a really convenient, whipping boy and great fear device. I mean, if you're a news media outlet, I mean, if you go into crypto news or you go into U.S. Treasury news, I mean, maybe it's more of a no-brainer now. And I could be wrong, but we'll see if that continues.
I think it's a function of the manner in which we consume news now, which you said, very eloquently. I mean, Bitcoin was born in a digital age. It's a digital asset. And now we live in a world where opinion is news. News is 24/7. Listen, I'm 44 years old. When I grew up, you either watch Peter Jennings or Dan Rather once a day, and that's how you consumed your news. And that was it. There was no 20, CNN maybe started in the early 80s when I was a kid, but there was no 20, people didn't watch the news 24/7. There was no social media. They weren't consuming this stuff. You watched your 30 minutes of news. You got the key stories, generally with actual facts being presented, God forbid. And you went about your life. But now we live in a world where everybody's talking about everything all the time, and every single person views themselves as a justified media personality. Every person with a Twitter account, they've got their voice, and whoever's listening to them, they're their own network, even if it's only 17 people listening. And that's the way that people sort of approach the world now. So yes, I think it's just all amplified by the very nature of the media, and because it's an asset that the big players probably are starting to take notice of and potentially fear. I don't believe, I'm not so hyperbolic that I believe that they want to kill Bitcoin because they think it's going to replace the dollar and all those sort of maximalist opinions. But, it's the old saying, first they ignore you, then they fight you, then they join you, whatever. I think we're at the then they fight you phase. After thinking they could ignore it and it would just go away, now it's not. So we're seeing the news kick in.
Yeah, I was actually talking to a couple ex-Wall Street traders this week, one of them being Dan Morehead of Pantera Capital. And they both said a few things that were quite interesting. First of all, Dan was the first to say that the guy that sat next to me at Goldman Sachs was, Steve Mnuchin, who became the Treasury Secretary. And so to not assume that Wall Street and the Treasury are a revolving door is naive. He also, or another guest mentioned that the truth is if you're a fund manager, and you see Bitcoin becoming an asset that's appreciating and you don't get in on it, then your competing fund manager is going to get on it and you're out of a job. And so there seems to be real wealth getting in on this. If JP Morgan's putting funds in there and client assets and Goldman Sachs is, those same guys at the Fed are probably not going to shut the door on them because it is part of their business. And so you have to remember, at the end of the day, it is a little about fear and greed. These funds potentially want in because they need to beat the S&P 500, right? They need to beat the returns. And sometimes it is that simple. And sometimes it's not that simple, Scott. But I think some people need to realize sometimes it is that simple.
Some great points you just made there and things I talk about all the time. One is that Paul Tudor Jones and Stanley Druckenmiller and Bill Miller and all these billionaires who are now proponents for Bitcoin don't make that decision without knowing it's not going to get banned. I'm sorry, these guys are not going all in, in the media on Bitcoin without calling someone first to make sure that they're not going to be on the wrong side of regulation. So that's one, and you touched on that. The other is a very interesting shift that I think we've seen in the past 2 years that you also just mentioned, which is I think there was huge reputational risk to supporting Bitcoin or cryptocurrency in the boardroom until last year. I think even if you loved it as a risk manager, as a portfolio manager, you were going to be nuts if you threw it out on the table and said, I want exposure to this, right? You didn't want to be first. I think that's flipped.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.